All right, everyone, time for another market update. Happy New Year. It is January 2022. And I want to kick things off with showing you the 6 month performance of the market. There's been a lot of pretty amazing things that have happened in 2021, but just over the last couple weeks of the new year, we've seen an absolute it's just really incredible outperformance in energy over everything, but especially over technology. The rotation that had happened in 2021, but to an even greater degree now, is really starting to take hold, and this is kind of a really is something to see. So I want to start off with the 6 month performance of the market, and you can just take a look here. You know, over the last 6 months, Amazon's down. Alibaba's down, Wayfair, Etsy down. A lot of these names that you're probably pretty familiar with are down here. Newegg Commerce. I mean, we're not talking down a little bit either. We're talking down over the last 6 months, 60%. Farfetch is down 41%. Wayfair down 40%. If you go over to the software side of things, you're looking at DocuSign down 55%. There's some names that have popped up. You know, Datadog did all right over the last 6 months. Team Snow has done all right. App has done pretty good. AppLovin, 30% over the last 6 months. So some of these names have actually held up pretty well, but you can see that the clear out performances in financials. You can see that energy has just bright green. Apple being Apple, doing what it does, going up every single day like it always does. And Apple has done pretty good over the last 6 months. The semiconductors like AMD, NVIDIA, Taiwan Semi, Qualcomm, Micron, Marvel, all done extremely well over the last 6 months. But I want to show you kind of how, this kind of evolves over the course of the last 6 months. So, we're going to go dig into the 3 month performance. So over the last 3 months, things are looking a little less green across the board, really, even for financials, even for energy, but especially for software. Software is getting dismantled right now, unbelievably dismantled. And then we go to a 1 month view, and things start kicking back up for energy and looking really grim for software. It just keeps getting worse. So you're seeing software really get taken to the woodshed. Baba has popped back up. Wayfair over the last month down 17%. Some of these moves. I mean, financials just crushing it. Energy crushing it. Aerospace and defense doing all right over the last month. Some of the other metals, steel, copper, have been doing pretty good. So, and then over the year-to-date performance, you're looking at some of these energy names just over the last 10 trading days, the last 2 weeks of the year, you're looking at 15-20% moves across just about all of energy. Just an unbelievable start to the year. And you're seeing, again, further and further down these software companies are going, these technology companies in general. So another way to really look at this is to show you this chart. And what you have here is you have XLE is energy. So you have consumer discretionary, staples, energy, financials, healthcare, industrials, materials, real estate, technology, communications, utilities. These are all the ETFs, the spider ETFs for these sectors. They're not equally weighted, so they're not really like the best way to look at all of energy. But in terms of just looking at, okay, we want the best energy names, and we want the best energy names to be the highest weighted within the ETF. These are the ETFs that you go with. So energy, this is just year to date. Just the first 2 weeks of the year is up 16.23%. While technology is down 4.66%. I mean, we're talking about almost a 21% spread just between energy and technology. So why does that matter? Does it even matter? Hey, it's only the first 2 weeks of the year. Who cares? Well, it matters because we haven't seen that in a very long time. And Jordi Visser of Weiss, he does these are free. You could just go to the website, go to Insights, and you could check these out. But he brought this up historically. The last time that XLE, the spread between XLE and XLK, which is energy versus technology, the last time it's outperformed to this magnitude, we haven't seen it outperform like this since 2007, since 2006-ish, 5, 6. But the last time energy's outperformed in general, just outperformed it all, is right here, this zero line. So we're talking 2015, 2016, it outperformed a little bit. But technology has really dominated for the better part of the last decade. You had these little blips from energy, but that's about it. But what's really interesting to see is that the degree of which this has changed, the degree of which people started dumping their money into energy and rotating out of technology. And this doesn't necessarily mean that this is going to continue to this degree. But what it does mean is that people are starting to see a shift in interest rates. They're starting to see a shift in inflation. They're starting to see a shift in the supply chain that is still under great stress right now, especially when it comes to oil, when it comes to liquid natural gas, when it comes to power in general, especially during the winter months. So people are starting to see that, but what they're also starting to see is that, hey, COVID, and everybody has their own opinion on COVID, and I'll leave them to have their own opinion on it. But if you just look at the data, the Omicron variant is the one that spread through the population the quickest. So it seems like it was a more mild variant, which is good, which is great to hear. And it looks like we're finally starting to see the light at the end of the tunnel. Now in 2021, just to give you a little idea of how this kind of worked out in 2021, if you were just to take energy throughout 2021, right around this time period here, say from June all the way to September, we were dealing with Delta. So the Delta variant was really hitting us hard, headline. And one of the things that, if you're going to look at energy, you're really just looking at demand, right? If people have more confidence to travel, if they have more money to travel, if they, have more time and these are all the things, energy plays such a huge role in every single part of our supply chain. People can't get to work without oil and gas. Machinery can't run without oil and gas. So you really need to understand that, when you look at energy in general, especially at oil and gas prices, that, if the supply chain starts getting stressed, it really is not a good thing. It really is something that's going to push inflation higher and higher and higher, because energy plays such a huge role in everything that we develop, everything that we create, everything that we make. So you have this, coming into 2021, you had this massive move, right? So from, October, I think I've showed you guys this 100 times. You have 100% move in an ETF over, say, a 4, 5, 6 month period, and then you take this little dip, which I don't believe had anything to do with Delta, but it pops back up, and then the Delta variant really, really controlled the headlines and kept energy down. You can cross this with crude oil prices, and by doing that, you could get a decent look at how that kind of played out. So, as oil prices go down, you also have the ETF going down. As oil prices go up, you have the ETF going up. They're pretty correlated at this point. I feel like they're a lot more correlated now than they've ever been. I mean, you can look back, during this period, they're pretty much dead correlated. But if you look back over the last 10 years, they're more semi-correlated, not as correlated as they are today. So as demand goes down, energy goes down. As demand goes up, energy goes up. And really, it's not just the demand side, it's the supply side. And you can go to 100 different articles about why we're dealing with a supply crisis for energy. Our biggest problem is that over the last decade, even maybe a decade and a half at this point, we've been telling oil companies and gas companies, no, you can't develop pipelines. No, you can't drill here. no, you can't, mine for these minerals or these materials. No, 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 no. No, put it into solar. No, put it into wind. And the problem with that is that even though it sounds good, even though that money can go into the renewable energies, the problem is that you never transitioned. Renewable energies does not currently have the capacity to back us up when we have an issue like we have right now, where we have really high demand and we have low supply. Solar isn't filling that gap. Wind isn't filling that gap. We don't allow nuclear like we used to. So nuclear doesn't fill that gap. So that's a problem. And so energy, oil and gas have actually benefited hugely from this. I've had many people, I've had clients tell me they want to make sure that they're invested in solar, and the problem with that is that, solar comes down from these heights in 2008, 2009, and it bases for a very long time. This is actually an extremely bullish chart, but one of the things you have to realize is that, and I think we've talked about this in the past, the best way to tell that Biden was going to become president is that everybody was dumping their money into solar, thinking that Biden and the administration was going to push solar at all costs. Well, the pandemic comes, and now we have an issue, right? Now we have a pretty big issue where, okay, well, solar capacity isn't getting the job done and wind capacity isn't getting the job done, and we have to rely on fossil fuels. And now that we have to rely on fossil fuels, well, that just means that demand is going to keep going up for fossil fuels, and the supply is just not there because all of the capital expenditure that was going to be used to develop greater supply in the future has been choked off over the last decade. So this is actually a super bullish chart, but the problem is that people who want to get in, look, this thing, if you look at a sentiment chart, and I don't know if I have to bring that up again, maybe you go to some of my past videos, but the idea of a sentiment chart is that everybody gets super excited. Now this is an ETF. This ETF came out in 2008, but I'll make the assumption that in 2005, 2006, 2007, it went something like this. It probably went parabolic up because you don't get parabolic down like that unless it goes parabolic up. So you have this massive move up, then you get this massive move down, and then you just base sideways for years. And again, that is generally bullish structure when it comes to just technical analysis. So now the idea is that you need something to push it above, say, like these levels, and then it can just get going again. Well, right now, a lot of these solar companies tend to be in the basket of they're not profitable. So not really growing as fast as they should be because there hasn't been enough government money pouring into it. So not growing as fast as they should be and not profitable. Those types of companies right now are getting taken to the woodshed. It doesn't matter if it's solar. It doesn't matter if it's cannabis. I can show you cannabis. It doesn't matter what it is. It is getting taken to the woodshed if it is not profitable. This is not the environment to not be profitable. Why? Because interest rates are rising. So you don't want to borrow money as interest rates are going up and up because it's going to cost you more and more to borrow money. So we're currently still at pretty historically low interest rates. But if this starts turning up and you look at this and you go, Kyle, what are you getting excited about? What could you possibly getting excited about? If you were to just zoom out on this and you look at this little blip over here and you're telling me it's going to reverse all of this over the last 40 plus years, well, look, the thing is that we've never had the type of stimulus that we've had. Never. Ever. And the only way to kind of take some money out of supply, right? Because the government just shoved money into every single corporation's face, every single resident's face, citizen's face, and here, take the money. Well, now there's all this excess money. And it's going to end up chasing goods. And people are going to use that excess money to pay higher and higher prices for all these goods, unless you raise interest rates. That's the only way to do it. So, well, it's also taxes. So either taxes increase to pull money out of the system, or interest rates increase. So you have to pull money out of the system one way or the other. There might be another way or two. So why am I getting excited about this? Is because somewhere around here we introduced trillions of dollars into the money supply. And so with that introduction into the money supply, you now have a runway for this start to reverse, for interest rates to start going up. So this is the 10-year yield. It's at 177, and if it cracks 2, if it cracks 250, things start getting very, very, it's going to get very wild. Let's just say that, because every company has been assuming low interest rates for such a long time that if interest rates start to rise in any meaningful way, they're going to have to completely rethink their business structures, right? If you can't borrow the way that you've been borrowing because interest rates are higher, that's going to be a problem. That's a higher cost of doing business. So all the valuations you see and all the money that's been thrown at these non-profitable companies, it's because money's free. If money's free, you can take higher risk. And that's kind of the main point of that. But to go back a little bit now, because I don't want to get into like a deep bond discussion. So inflation's rising, and I don't know if I need to go through this, but let's boogie a little bit here. So if we just look at things like aluminum prices took a couple months off and rising again. I think we had looked at lumber. I think lumber was the chart. So look, lumber goes all the way up, reaches a peak in May of 21, spends 4 or 5 months coming down, and then look what's happening now, just right back up. Just if you look at crude prices, we haven't seen crude above. So first off, it topped out in October, November crude prices and took a really big spill in November. We're back up at those prices again. And if I were to extend this out a little bit, look, we haven't been at these levels since October of 2014. And so if you look at some of the prices of like ExxonMobil, you look at some of the energy company prices back then, much, much higher than today. So there is a lot of catching up to do when it comes to energy companies versus crude. And look, again, I say semi-correlated because if crude goes up 10%, it doesn't mean that every single energy company goes up 10%, right? That's not how this works. But what it should confer upon you is that the higher the price of oil, the more profitable these companies become. The more profitable these companies become, the higher their market cap is likely to be in an inflationary environment, because they actually are valuable, right? They actually make money. Whereas a software company is going to start paying higher rents, they're going to start paying all their employees more, and they may not be able to transfer that cost to their customers. So that's why it's very important to look at cyclicals right now: materials, energy, industrials, retail, because these companies make money. They're actually worth something. You're able to value a high growth, no profit company when interest rates are low, but when interest rates get higher and when inflation starts kicking in, it becomes harder and harder to justify the multiples that those companies are receiving. So crude's up there as well. Copper, this is a scary chart. And the reason why this is scary is this thing's been basing since May. So if you were to overlay this with XME, now XME is metals, so it's not just copper. But they've been kind of doing the same thing over the last handful of months, right? Get up, base sideways. XME is just starting to break out a little bit, while copper is still in its range. But it's really, really important to look at this, because that's another kind of indicator right? As copper prices continue to go up, that infers more demand and less supply, and that's going to make things more expensive as well. So the other one is steel, which steel has actually came down. This is hot rolled coiled steel. So this is going up and up and up and up and up, pretty much unstopped for the better part of almost essentially a year, essentially 12 months. So non-stop for 12 months, it's finally taken a little bit of a breather, but just look how high steel prices are right now compared to all the other prices. And we'll go back to lumber real quick. We had talked about this in the past. It's, you know, when we talk about inflation, these peaks don't infer inflation. It's where do prices resettle, right? So in the 80s, prices were for lumber were around 100, 200, 300. Well, you know, in the late 90s and 2000s, they were between 200 and 400, 500. So again, these peaks are mainly because of supply disruptions. The supply's low, demand's high. But, you know, when this starts to shake out, you know, will lumber be above 500, above 600 going forward? That's going to be what's important to really look at. So we're going to be keeping an eye on that. And one of the last things I want to talk about here is a little bit of a warning for people. So everybody's thrown their money into passive funds, and a lot of passive funds have invested in the same 10, 20, 30 companies. And those 10, 20, 30 companies have gone higher, 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 higher. You can look at the Apples of the world, the Amazons of the world, the Googles of the world, so on and so forth. And listen, like, your best performers should be your best companies, in which they are. If you look at Apple, one of the best companies in the world, it deserves, in some respects, its market cap. But even still, it's just so stretched. Everybody is in. And what a lot of people don't realize is that from an institutional standpoint, from a mutual fund manager standpoint, from just a fund manager standpoint, is that when you start getting under a little bit of heat, you're going to start taking some off, and you're going to need a place to put it. And so just from a momentum standpoint, if Apple starts to lose momentum, and you can make the case that it's starting to lose momentum, even though it's kind of going straight up here, you're talking about incrementally higher high, incrementally higher high. So Apple, let's just compare Apple real quick to, let's compare it to something like XOM. So black is Apple, orange is ExxonMobil, and we can make this look really bad real quick. So if you just bring this all the way out, you know, if you invested in ExxonMobil back in 96, 97, you did 218%. Apple, you did 77,000%. So just keep that in the back of your head real quick. If you look at how they've performed in 2021, just 2021, Apple still, well, I guess in the first couple weeks of 2022, Apple did 33%, ExxonMobil did 73%. Let's go back to 2020 real quick. Over the last 2 years. Over the last 2 years, Apple up 132%, Exxon 2%. Okay? Now let's just do this from the pandemic bottom. From the pandemic bottom, Apple 182, Exxon 108. Why am I showing this to you? It's important to realize that what it's been doing over the last couple of years, Exxon is trying to get itself out of the bottom, and it has all of the tailwinds right now to do so. Whereas Apple, even being the best company on earth, everybody owns it. And we've talked about this before. If everybody owns it, there's no buyers left, right? And these moves here, and I think we've done the Microsoft comparison. I forget if I did the Microsoft comparison on the last video, but if you look at Microsoft back in 99, 98, 99, it did the exact same thing. And what this pattern suggests is that it's running out of buyers. That's what it's suggesting. So the reason why the pattern's repeating, and what I mean by that is, a bunch of standard deviations above the average trend, and then it goes parabolic, and then it starts making these incrementally higher highs, and then it has a blow off move, and then it dies. So it's not necessarily do fundamentals matter here more than they matter here, right? Fundamentals mattered here, but they don't matter here. So the problem, in my opinion, with Microsoft is probably making a crap load of money, right? They're making money here, they're making money here, they're making money here, they're making money there. But unless you're noticing how this is playing out, it's tough to really say when the top is, right? And I'm not necessarily saying that, because this pattern is playing out again, that we are at a top. Well, I guess what I'm saying is that what this pattern infers to me is that we're going through that same process where we're trying to soak up the last amount of buyers. And so, is Apple going to go to 200 or 210 before it takes its turn down? Maybe. Maybe it's right here. Maybe this is it. Maybe this was that parabolic move just like Microsoft back in 99. And now it really only has down to go. It's tough to say that to a company like Apple, but Apple's now, I think if it's above 175 or if it gets to 180, I forget, but I mean it's a $3 trillion company somewhere up here. So if it's a $2 trillion company, I don't know, somewhere over here-ish, is $2 trillion that unreasonable for Apple and all of its cash and all of its growth and all of its profits? It's like you really, really have to think okay, why would I take the chance, or why would I buy here for the next 10-20% when that's not where the tailwinds are? The tailwinds are purely behind materials. They're purely behind energy. And it's not pretty to be invested down here. I mean, it was very tough actually in 2021. You get this down move, pops up a little bit, another down move, pops up a little bit, another down move. It's not just like this very, up and up and up, and it's tougher. It's tougher to be invested in something that hasn't been going up for as long as, say, Apple has. But you don't need to adjust your positioning every year as much as you should just adjust it every decade, right? Every 15 years or whatever. So, but the reason why Apple is where it is, and to go back to my original point, is because of passive flows. And so what this is showing you is your annual net flows for active funds by fee quintile, which basically says, hey, look at how people started devaluing active investing, right? So if you have high fees, you get less money. If you have low fees, you get more money. That's all that shows. If you look at some of these ETFs here, these are the most popular ETFs, top 100 ETFs by trading volume. And so all they are is they're just trackers. Just tracks the S&P, just tracks the financials, just tracks technology, just tracks emerging markets, just tracks Russell. These are the most popular ETFs, and all they do is just track a very broad sector or a very broad index. And that's all they're doing. This is not specific. You don't need to be super specific, right? If you just want broad exposure to the market. So that's where money's been flowing. And as you can see, it's a lot of money that has been flowing to these passive ETFs. And all the money that flows to these ETFs end up flowing into the Apples of the world, right? Like Apple is in this one, Apple's in that one. it's which is the top, two of the biggest ones, right? So, and you can see it here. This is just since '09, but it's really been happening even further back than that, where active money flowing to active funds has just been falling off, while passive has just been grinding higher. What else shows you that? Well, if you look at the performance of the S&P 500 versus the Barclay Hedge Fund Index, you could see, so the dark blue is the S&P, the light blue is the hedge funds. You could see that, like, in the current environment, you just need to, like, latch onto the S&P and that's it. You'll outperform, you'll do fine. You don't need active management when everything's going up. When have hedge funds done a good job? You could see that during the move in 2008, the global financial crisis, they outperformed. Just prior to the global financial crisis, they outperformed. The dot-com bubble, they outperformed. They outperformed in 2000, in 2001, and 2002. These are all periods where hedge funds were super valuable, where active investing trumped passive, essentially. And so when I look at this, what I get from it is I say, okay, in most cases, over most years, you just have to ride it. Just ride the market. But there's going to be periods of time where, like, having some exposure to a hedge fund or an active investor or active fund, just in general, mutual fund, you're better off that way. So what you're seeing now is the S&P has done extremely well over the last, say, 4 out of 5 years, right? Just so good. 22%, takes a tiny baby hit in 2018, up, just has done extremely well. But what I would say is that we're getting into a period where that may not end up being the case. So I can't wait to look at this chart again 10 years from now and see if hedge funds have finally caught up. Because the S&P, in my opinion, over the next 2 or 3 years is not going to do well. I don't believe that the market as a whole is going to go up the next 2 to 3 years. I think the market's going to go down. But when I say the market, I'm really just talking about, say, the S&P. I'm talking about the NASDAQ. I'm talking about the Dow. Maybe less so the Dow, because it's only 30 stocks. But I think the market in general is going down. But I don't think that every single stock within the market's going to go down. And I think we are going to continue to see rotation into energy, continued rotation into financials, continued rotation into industrials. And you're going to see money, billions of dollars of market cap that these companies have, and they still haven't turned a profit. That's going to get sucked out of those companies, and it has to go somewhere. And so that's a huge opportunity for people who are already invested in some of those areas. And again, just to go back to this chart, just so I could show you, it's like, look. It's almost a 20% outperformance in 2 weeks, and it's been a long time since that's happened. And if you can escape a bad year by being overweight in some of these areas, that pays huge dividends throughout the course of the lifetime investing. And that's why I think it's important not to always be in and out. I don't think being overly active is a good idea, but I think, you take moments like these over the last 2 years since the pandemic, you take these moments and you look at, okay, yes, I hear about Apple on the news every day, and I hear about Salesforce, and I hear about DocuSign on the news every single day. And yes, these companies are great, but is that where the greatest opportunity is over the next 3 to 5 years? And so that is something that I keep kind of pressing on a daily basis with friends, with family, with clients, that you have to really look at this in terms of the next 3 to 5, even 10 years out. Where should you be putting your money? When is this rotation actually taking hold? I think it is. I think with COVID variants behind us, which COVID variants, when they came out, they hurt value in a material way. every time that a new COVID variant would hit the headlines and the demand would go down a little bit, energy got hurt the most, and financials got hurt the most, and materials. And once we get that behind us, and inflation takes hold and higher interest rates take hold, those headwinds of the variant headwinds, I guess, is maybe the best way to say it. Once that's behind us, I don't see a lot more headwinds after that. I could be wrong, but I think the next 3 to 5 years, you just have to stay away from being passive. You have to stay away from just throwing your money in the SPY and just latching on to the index. I think that's worked really, really well over the last 12 plus years. I think that was an excellent idea. That's never something that I would do, but from just an investment standpoint, I think that's all you had to do over the last decade plus. So I hope this was helpful. There's some things that are really shaking out. If you want any specifics on, where some of your money should go, ETFs, mutual funds, stocks, I could give you some great ideas. We're a little bit past, in my opinion. I really don't think we're gonna see some of these prices for a long, long time, especially in the energy and material names, even in the financials. So you're going to have to pick your spots, ride out a little bit of fluctuation over the next year or so, but over the next 3 to 5, I think these are the places to be. These are the places that will outperform. So I hope that was helpful. Again, if you have any questions, always just shoot me an email or text me, whatever you want to do. Take care.